The U.S. stock market is sitting near record highs. Investors are celebrating a massive rally. Driving those numbers is an intense artificial intelligence arms race. Technology companies are spending enormous sums of money on computing infrastructure, data centers, and the physical chips required to power AI software. But high stock prices create high expectations. When valuations reach extreme levels of optimism, companies have zero room for disappointment. A strong earnings report is no longer enough to satisfy investors. They demand perfection to justify the premium they paid, which is why a crack in the broader economy caught the market entirely off guard. This chart shows U.S. job creation dropping below the expected growth threshold in July, unexpectedly losing 23,000 jobs. Yet looking at the wider data creates a paradox. Notice the secondary axis. At the exact same time, the unemployment rate actually fell to 4.1%. This unusual labor data immediately scrambled Wall Street's focus. Investors stopped looking at technology earnings headlines and started watching the Federal Reserve, waiting to see how they will handle the next major piece of economic data, the July Consumer Price Index. Silicon Valley's technological ambitions are now colliding with a specific piece of economic data, the August 12th Consumer Price Index. Policymakers at the Federal Reserve find themselves in a tight spot. They typically cut interest rates to stimulate economic growth and support a weakening labor market. But inflation acts as a hard barrier. If consumer prices remain stubbornly high, the Fed cannot safely lower those rates without risking another explosion in the cost of living. These rate decisions ripple outward instantly. The Fed sets the baseline cost of borrowing for the entire economy, dictating the math for everything from your mortgage and auto loan to massive corporate debt. That baseline borrowing cost is particularly lethal to high-growth AI stocks. Technology valuations rely on the promise of massive future profits, but when interest rates remain elevated on one side, those future dollars are worth significantly less when measured in today's money. Elevated rates automatically shrink the mathematical value of tech companies. That brings us to the upcoming CPI report. The inflation data acts as a trigger mechanism that will force one of three distinct chain reactions. Scenario 1. Inflation comes in cooler than expected. The top pathway lights up. The data gives the Fed room to cut rates, sending tech valuations climbing. Scenario 2. Inflation exactly matches expectations. Following the middle pathway, the reaction is balanced but highly unstable. Investors remain optimistic, but volatility keeps the market on edge. Scenario 3. Inflation comes in hot. The bottom chain snaps tight. The Fed is forced to keep rates high. Treasury yields spike in response, and the tech valuation node shrinks. A hot inflation number forces immediate pain. Investors have to reconsider their rate expectations and admit that some stock prices have moved entirely too far ahead of the actual economic fundamentals. The August inflation report effectively determines whether the math behind these record-high valuations can withstand the reality of the Federal Reserve's next move. Shifts in interest rate expectations move the U.S. Treasury market, directly impacting the yields on government bonds. Those changes in Treasury yields subsequently dictate the strength of the U.S. dollar and ripple outward to reprice global bond markets and commodities. But the most acute pressure point is happening far away from trading floors, right in the wallets of everyday citizens. Consumers are currently trapped in a double squeeze. If you manage to negotiate a higher salary, those wage gains are rapidly eroded by the rising cost of groceries, rent, and insurance. Simultaneously, those elevated interest rates make carrying balances on credit cards and household loans punishingly expensive. The ideal path forward is one where corporate earnings remain strong, inflation moderates to a comfortable level, and employment stays stable. But economies rarely move in perfect straight lines. Financial systems are ruled by a single behavioral law. Markets do not react to historical headlines. They move entirely by constantly updating their expectations of what is going to happen next. So watching the stock ticker go up or down on one morning will not give you the full picture. You have to analyze the economic data driving those trades. The upcoming CPI report is the exact metric that will reveal whether the current market rally has room to run or if it's about to hit a solid wall of economic reality.